Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Friday, March 26th, 2021. It's another rally day. I got to give the market some credit here. This was shaping up to be not a pretty week. We did have the big rally on Monday for the most part, but even then we kind of gave back a lot of the gains and not all the indices were higher. Russell was down, although S&P was up and NASDAQ was up. And then we had pretty much a series of ugly closes. Markets trying to rally and gave it back. And then yesterday really reversed the pattern and sort of out of the blue. I think it's because we may have started too bearish and then actually we went through some support levels on major indices, but somehow I never know where these rallies come from. There's always the argument that the plunge protection team or whatever you want to call it. I don't think that was the case. I just think the market's got a bit oversold in the short term, and people are still conditioned to jump on rallies. I know it sounds better to buy the dips, but I think people like to see someone else really buy the dip and then buy it as it turns up. The best example this week of that, of course, being GameStop, where after the numbers, the stock sold off after the results. And then yesterday, mysteriously, the stock zoomed higher, about 50% for no apparent reason. But this is the kind of market we're in. Rallies, take on a life of their own a little bit. So for the week, what we're looking at now is an S&P that if we were to close here, sorry for looking at another screen, but just to get the numbers right, if we were to close here, we would be up modestly on the week in the S&Ps, probably about 15 or 20 points. But NASDAQ would still be fractionally lower and Russell would be relatively significantly lower. I think what we're seeing is the continued rotation. And I think what we're also seeing is just the market conditioned to be jumping in. It's still a momentum-driven market. And that's, I think, the feature that we're going to get here. Now, the thing that kind of worries me is the pattern of lower lows and lower highs. That's never a good technical sign. The VIX index is down a little bit. We're sort of got the new range of sort of 18 to 20 as opposed to 20 to 22. As I wrote earlier this week, I think that was more of a function of a change in the mindset of people being less eager to hedge on the downside, while the volatilities to the upside still remain relatively firm. So the skews are a little bit different. I urge you to look at the stuff we'd written earlier this week about that for a fuller explanation. The rest of this week, we're seeing the bonds. Just keep checking because my stuff is on the other screen for the most part. Bond yields about 165, so they did flirt with 175. Then they flirted with below 160. They seem to be finding a level. Things seem to be finding a level. I think one of the more interesting things is a lot of people expected what I'm going to call the post-stimulus bounce. That hasn't really come into play. I wrote yesterday, I don't think it was a coincidence that S&P hit its high on February 17th, which is the day that the stimulus checks arrived and really had not done much since then. Now, we're flirting with all-time highs, so let's be clear, being a couple percent off them is hardly reason to be concerned. But I think there was a definite buy the rumor, sell the news mentality in place. Was anybody not expecting the stimulus to come by the end? No, it had gotten priced in, and I think that's kind of what we're seeing. Also, I think one of the reasons that we saw some of these ugly closes this week is positioning by large institutions ahead of the end of the quarter. When you see the market fade in the last hour and a half hour of the day, and especially when it accelerates kind of late in the day, that's often a signal that institutions are the ones behind that. They've been probably selling through most of the day. The sell side traders tend to be marked to the VWAP or to the close. So in either case, it kind of behooves you to save some ammunition. If you're selling all day, save some ammunition till the end. The liquidity gets a little bit lighter at the end of the day sometimes because people don't necessarily want to go home long position. And that's one of the tells. Why would they be doing such a thing? Well, for the most part, they've had a good quarter. Stocks across the board, for the most part, are up year to date, which of course at this point is quarter to date, the same thing. And also, one does have to consider whether there are some asset allocations going on. When we came into the year so far, yields were a lot lower than they are now. I'm talking longer end of the curve, 5 years on out. 2 years still remain very low and essentially negligible. But if you're talking about maintaining, let's say, the 60-40 portfolio or something of that nature, you would be doing an asset allocation to move some money from the stocks that have performed well into some bonds that have not and might offer you a little more of a yield advantage relative to what you saw earlier. That's my hypothesis for now. We'll see if that persists. Yesterday, the trade there was no selling late in the day. Today, we're taping this, about 10:30 in the morning, so I have no idea what's going to happen at the end of the day, and I think we have to look forward to seeing what's going to happen there, and we have to look and see what's going to happen into next week. Do we continue to see some of these asset allocation trades? Were they just sort of a couple of days wonder? And I think that really becomes the question, and we will know over the coming sessions. Have a good weekend, everybody, and we will talk soon. Take care. Bye-bye.